Welcome back, guys, to Forex Beginner's Guide video 106. On today's topic, we will be covering what is leverage. So, in Forex trading, leverage is a tool that allows traders to control a large position in the market with a smaller amount of capital. Essentially, it's like borrowing money from your broker to increase the potential size of your trades. When you trade with leverage, you're able to magnify your exposure to the market, giving you the opportunity to make larger profits or incur larger losses with relatively small investment. Think of leverage as trading with a loan. You can use a small portion of with your own money to control much larger positions. For example, with a leverage of 1 to 100, you can control 100 times the amount of your initial investment. How does leverage work while trading with gold? So, suppose you're trading with $1,800 account and you don't have to invest entire 1800 on a single trade. Leverage allows you to put a smaller margin, such as you can risk only $18 of that. With that sort of capital, if you've got 1800 in your account, leverage allows you to trade with a smaller investment than the entire amount. You don't have to put one trade with the entire 1800. That's what leverage helps you with. Examples of leverage in action. Let's say you're buying gold at 1800 using a leverage of 1 ratio 100. Without leverage, you will need the entire 1800 to buy 1 ounce of gold. With a leverage of 1 to 100, you only need to use $18 of your margin to control the 1 ounce based off of gold worth on your 1800. If the price of gold moves by just $10, your profit or loss would be $10 per ounce. But since you're using leverage, your return is amplified. For example, if the price of gold rises to 1810, you'd make $10, but if the price falls to 1790, you would lose $10, not the entire amount. Why use leverage in gold trading? Increased profit potential. Leverage allows you to take larger positions with a smaller initial investment. For example, with a 1 ratio 100 leverage, you can control 100,000 worth of money with just using $1,000. Capital efficiency. You don't need a larger amount of capital to trade a big position. It allows you to access bigger market opportunities with a smaller amount or smaller deposit. The risk of leverage. While leveraging can amplify your profit, it can also magnify your losses. If the market moves against you, the losses are calculated on a full size of position, not just the margin. Example, using 1 ratio 100 leverage means you can lose more than your initial margin deposit if the market moves significantly in the wrong direction. Therefore, it's crucial to use stop loss orders and manage risk carefully using leverage. Leverage versus margin. For instance, if you're using 1 ratio 100 leverage for gold, the margin required would be just 1% of the total position value. So leverage is the ratio that indicates how much larger your trade is compared to the margin you're required to put up. And margin is the amount of money you need to deposit with your broker to open a leveraged position. Conclusion. Leverage is a powerful tool in forex trading, particularly with a volatile asset like gold. It allows you to trade larger positions with smaller capital outlay, but it also increases the risk. It's essential to use leverage wisely and always consider risk management strategies. If you guys haven't seen the other videos on this beginner's guide, I would highly suggest to go and watch them now to learn more.